Hello, everyone. Welcome to the Sunday macro wrap up for Sunday, October 19th. Pretty wild week in the markets last week. We have a pretty good presentation for you guys here tonight, getting ready for pretty much, or actually, there's 2 more weeks in October, 2 more full weeks, that is. So, this is one of the longest government shutdowns that's been going on in history. As of last week, this is now the third, well, it's tied for third longest government shutdown in United States history. The second one being from December of 1995 to January of 1996. That was for 21 days. And then the first one, in first place, was from December 2018 to January of 2019, which was for 35 days. And so, if we go through this entire week, that'll obviously push it up to second place in entire American history there. And so, a lot of this government shutdown is delaying a lot of the key government data that the Federal Reserve needs in order to conduct its monetary policy. Inflation data, labor market data, all those things from the government perspective are being held up. And of course, we still get private data, which is important, but it's not as official as the government data, which is what the Fed actually pays attention to. So we'll see if the government shutdown is resolved this week. If so, then we'll get all the labor market data as well as the inflation data for September that will be needed. So I think they have that set to come out on the 24th, I believe, of this week. So we'll see if that happens. Not sure if it will, because when I look at other developments, in order to find a resolution or a continuing resolution for the government shutdown, I don't think they're anywhere close to doing that. So who knows? This could be a record breaker for the amount of government shutdown in terms of length, right? But we had another Trump China tariff scare that happened. And that was one of the main catalysts for the market sell-off this past week. And on Friday, we had a little bit of an ease in that as Trump came out saying, hey, we're going to come to the table with China. We're going to take it off. It's pretty much been his deal with a lot of these tariffs, right? He's using it as a big stick that he's waving around. And yeah, so I mean, that could just be something that's normal for this administration. And I think each time we go through that cycle, the market will probably be not as volatile as it comes through. But part of the big reason why we also had a large increase in volatility this week was that we had a big spike in bonds, or I'm sorry, we had a big spike in volatility because of a bond drop off, as well as a rise in credit spreads that we really haven't seen since the March scare. And so we'll get into that here as well momentarily. But the way that these Sunday macro wrap-ups work for those who are joining on our social media live streams, it's an hour long. For the first 30 minutes, it's streamed live to you guys. And then the last 30 to 45 minutes is actually held offline just for our Macro Optics members. And so if you're interested in that, make sure you reach out to us. We have a 7-day free trial of our macro investing community that you guys can take advantage of there. But all right, getting right into it here, let's go over some of the macro data from last week here. We'll just run through it. We saw a pretty decent shrink in a lot of the different growth factors for macro indicators, one being the New York Services Activity Index. That shrank to a pretty large 4-year low there. As you can see here, that was a pretty big drop off if we go out and zoom out here for the past 10 years. Really, the last time we saw it at a negative 23 handle was all the way back in January of 2021, trying to recover from the pandemic there. And so, historically speaking, going all the way back to 2005, you can see that this negative 23.6 point print it's only been like this a few times in the last 25 years. One being, in 2012, the other one was the 2008 Great Financial Crisis, and then the last one was the pandemic. So, I mean, when it comes to the real economy, it's definitely hurting out there. There's no way around that. And I think that when it comes to this private data, the bond market and the Fed are paying attention to this. So I found that pretty interesting last week. So yeah, we did see a little bit of a hesitation well, it wasn't really a hesitation. It was a large sell-off within the financial sector regarding regional banks. And so a lot of people were calling this to be another regional banking crisis similar to March of 2023, which I don't think it's going to materialize that way, or else we would have saw a way larger spike in credit spreads. But you're starting to see a little bit of cracks here because you have to remember that even though the Fed is in a rate cutting regime right now, it's still way higher than the past 15 years. I mean, still at 4%. That's a lot higher than 0%, right? And so, I think that a lot of the high risk, markets in the financial markets like private credit and stuff like that, they're still hurting a lot with these higher rates. And I think that the Fed is trying to do as much as they can right now in order to flood the system with liquidity. But with the RRP pretty much all drained up, as well as them reducing reserves on their balance sheet continuously, even though they signal that they're going to start reducing or coming back on quantitative tightening, that still doesn't mean that they're going to do quantitative easing, right? So I think the credit stress is still there in the background, and it's never really gone away since March of 2023. And so this could be accelerating here. We'll have to see what happens this week with that. Small business optimism index did come down a little bit, finally below 100. Still kind of elevated, but compared to this time last year, as you guys can see, ever since the election, small business optimism has been accelerating, and so that definitely hasn't slowed down. Well, it has slowed down a little bit here most recently, but it's a lot higher than it was a couple years ago. Let's see. The New York Fed Manufacturing Index did have an acceleration that might have to do with a lot of new orders that are accelerating due to the holidays, as well as the tariffs there. Yeah, so new orders did have a decent spike. Prices still remain elevated, but not as much as they peaked out in August of this year. So those came down a little bit, which is a positive development for the manufacturing side of things. But you can still see that it's remaining in contraction. So that was what the Philadelphia Fed Manufacturing Survey, actually. So that's what we saw there. And then you did see a huge spike in the home builders sentiment index for the housing market. And that's really just mainly to do with the expectation that rates are going to continue being lowered, which that will be the case here. So yeah, some optimism there with rates coming lower with the housing market. We'll see what happens there. I mean, if rates do end up coming lower, then I don't really see housing prices coming down that much unless you have a full-blown credit crisis. But at this point in time, we're not really seeing that there. So yeah, lots of mixed macro data, really. That business leader survey, though, that did not look very good. And so you're definitely seeing some cracks and slowness in the real economy there. Let's take a look at the probabilities for the Fed target rate probabilities for October 29th. So this is the Fed meeting that is not this Wednesday, but the following Wednesday. And currently, there's a 99% chance of a 25 basis point cut. And there's actually 1% chance of a 50 basis point cut. So, at the timing of this video, there's a 100% chance of a cut. So there's no doubts about that according to the futures market. When looking at the in terms of inflation, when looking at the Cleveland Fed inflation nowcast, you see that kind of remaining around 3% for headline. But in terms of core PCE, which is the Fed's preferred inflation gauge, they have that starting to come down just a little bit here. Heading on over to the charts, though, the main chart that I like to look at in terms of getting a good read on the bond market's expectation of inflation is the 5-year break-even inflation rate, which, as you can see here, has been coming down. It's better to look at this as a line chart instead of candles. But as you can see, over the past couple weeks here in October, this has come down a lot. And a lot of people have been asking, like, hey, if inflation's coming down, shouldn't that be bullish for the markets? It's always in context of what growth is doing at the same time, because if you want a Goldilocks type of environment, that would be slowing inflation but rising growth, and we're not seeing rising growth, across the board, right? We just saw it's at lows that we haven't seen since the pandemic, 2012 and 2008 Great Financial Crisis. And so if you have growth continuing to slow along with inflation, well, that's obviously not a great environment, right? Because that's kind of a recessionary signal, which is, sort of the reason why you had bond yields come down, right? The best way to get interest rates down is to have a recession. But, that's the fastest way down, not necessarily the only way, but that's kind of the signal that we were getting last week there. And what's interesting is that, looking at the 5-year break-even inflation rates, if I overlay a chart of Bitcoin, which is something that is very sensitive to inflation as well as, banking, take a look at this interesting chart, right? So as you can see, Bitcoin and this 5-year break-even inflation rate are, you have to adjust it based off of the time, but, you can see that, it's pretty much lined up here. And whenever I see Bitcoin do what it's doing, I'm the first thing I ask is, okay, what's the inflation expectations? What is that doing? And so as you can see here, you can pretty much tell that it's in a positive correlation. You have to adjust the percentages on the break-even inflation rate to kind of see how it lines up with Bitcoin, but just taking a look here from last year, if you guys remember in 2024, when it peaked around March of 2024 and then went sideways to down, look at what the break-even inflation rate did during that time frame, right? It kind of, treaded downward to sideways. And, this was in a bearish trend with Bitcoin at that time. And then once you saw a large spike in Bitcoin's price, you started to see a reversal to the upside of the 5-year break-even inflation rate. And so Bitcoin likes it when inflation is rising, and it doesn't like it when inflation is falling, when you have a weak growth type of environment. So, I think everyone should keep paying attention to what the inflation expectations are doing, because it's clear that those things affect Bitcoin, right? So that's one thing to keep in mind there. Let me go back to the candle chart here. Yeah, so taking a look at the 10-year bond yield, you can see that this is clearly in a bearish trend. That's why owning things like bond ETFs like IEF, which bond prices are inversely correlated to their yields, bond prices are actually in a bullish trend. So there was a little bit of a buying opportunity at the beginning of October there. And so let me see how much it's up. If you were to buy IEF, just to hedge yourself a little bit, it's up 131 basis points. That's not bad, for something that's a very low volatile, safe asset. Some people with a decent chunk of money would take that all day because, again, it's risk-free. And so with bond yields remaining bearish, anytime you have a little bit of a spike here, that could be a buying opportunity for bond prices themselves and some of these bond ETFs. Something like TLT is in a bullish trend, but since rates are dropping, the better bullish trend is in some of the shorter duration bond ETFs like SHY. So So those are some of the ones that my team and I like to look at. But in any case, all of this is causing a little bit of a spike in volatility to levels that we really haven't seen since that March sell-off earlier this year. And in our model, volatility did turn bullish trend on that spike. And then what's interesting is that on Friday there, it opened up at a very crazy level, and then it came right back down. It almost broke 30, which is pretty crazy. But Friday really was an interesting buy the dip type of day. And in our model, and as you can see with the lighting in the background of my bookshelf there, the S&P 500 still remains in bullish trend despite the spike in volatility. The best dip to buy was in small caps, right? So the ETF IWM for the small cap ETF by iShares, that had a really decent opportunity. And this continues to be one of the better bullish trends when compared to something like SPY. So, when it comes to the market, it still is maintaining its bullish trend despite all the fears that are out there and all the craziness. So, I mean, it's gonna take more of a drop for it to go bearish in our model, and I'll let you guys know when that happens. But yeah, I mean, it's still dip buying signals despite all of the bearishness that's out there. And it's something where we can just rely on our model for it to tell us that. That's what's great about this thing, is that it's whenever I tell you guys things, I'm reading directly off of what our model is saying. I'm never just telling you guys how I feel or how the market is looking like, right? All those very subjective nouns or words that people use that don't really have an actual process. They just say, hey, this narrative is happening because I like it, and you should follow it too. And because of this cool narrative, this cool story that's out there, let's all buy this one stock or crypto or insert whatever asset. Over here, we don't do that because we're solely relying on the numbers in our process. And so, that's kept us out of trouble, and it keeps us kind of level-headed through this craziness, So hopefully you guys can appreciate that. But I'm terrible at promoting our stuff here. So I mean, we're trying to grow our YouTube channel, but I could probably grow it faster if I was to promise all these crazy things like price predictions and all those types of videos. But they really aren't helping people in the long run. So from what we've found is that boring makes the most money. And that's what you guys want to do, right? You want to make money, not have your emotions drive your portfolio. But that's pretty much all I'm seeing here. One other thing is that when it comes to net central bank liquidity, it's funny how this is also lining up with inflation, right? So we've seen a large drop-off in net central bank liquidity because of the rise in the Treasury General Account, as well as the huge drop-off in the reverse repo facility. And pretty much the RRP is completely gone, right? There's no more money left in that. And that's been used to prop up the markets almost single-handedly the last, 3.5 years or so. So with that being gone, as well as we just saw a large decline in bank reserves to levels that we haven't seen since March of 2023. So yeah, what would definitely get this higher is if we had another regional banking crisis. So who knows? Maybe that would cause the Fed to, re-access some of those temporary measures, which ultimately still fueled the market to go up. So, I mean, yeah, with all of the, we're definitely seeing some changes, right? Because the dollar still remains in a bullish trend, and it's also near the low of the trading range. This could go back to bearish, who knows? But if this continues higher, I mean, that's definitely going to throw the market for more of a loop there. As well as some interesting developments with like the financial sector going bearish. This has been bullish for quite some time. So that's one thing that we're also seeing. If we take a look at something like KRE, which is the regional banking ETF. It looks kind of similar to XLF. But as you can see, this had a huge drop off on Friday due to that banking, or on Thursday due to that regional banking scare. And so this is one thing to look out for. And, instead of looking at headline news, you can just look at something like KRE and just keep track of the price. And, that'll tell you all the news that you would want to see with that. Um, you know, TradingView is an interesting platform because if you just click on one of these ETFs, it'll give you some of the news that's associated with that. Not that our process has to do anything with the news. A lot of the times it front runs the news, or most of the time it does. But what's cool is that you can take a look at something like these regional banking stocks, and it'll give you some updates on that specifically. Um, so yeah, that is what I'm looking at here. Some of the best performers still last week. Interestingly, even with that little bit of a sell-off there on Friday with gold, um, gold still was the best performing ETF last week, even though it had this little correction, which a lot of people were going bearish on gold just because it had a 1-day dip. Are you kidding me? Does this look like a bearish trend to you? Or is it a similar dip like we saw back on October 9th? To get gold bearish on our model, do you know how low it has to go? It would have to have a crazy crash. And, even if it does something like it did before here, where, it had a huge acceleration and then it went sideways for 4 months, that could still happen and it would not go bearish on our model. So yes, gold had a massive move over the past, month and a half or so. And, people are like, why would you buy it here? It looks like it's topping. It doesn't matter if it's topping or not. Okay. People were saying it was topping here. People were saying it was topping here. People were saying it was topping here. And it could, but it doesn't really matter. Because your goal should not be trying to time tops and bottoms. Your goal is to have exposure to bullish trends and to not have exposure to bearish trends. And you do that by just looking at where the money flows are going, what the macro is doing, looking at, which assets have the best trends, all of those different things. And so, yeah, tops and bottoms are only called in hindsight, right? So for the people, if you follow anyone who, they make their career out of doing that, I'm sure you've seen that their accuracy is very low on those calls, but also too, that type of thinking doesn't make you money. Again, we have to always bring it back to us preserving our purchasing power. The reason why most people try and go on and say oh, I timed the top, I timed the bottom, it's mainly because they're doing it within the self-interest of them calling it, right? How does that help though? It doesn't. Own bullish assets, don't own bearish assets. So yeah, even if gold has a bigger drop from here, I'm going to keep buying it. Okay. Because at the end of the day, our fiat currency system is in its later stages. And if you just look at the previous, couple thousand years of fiat currencies that are backed by central banks, they end up not lasting very long. And even though the United States has lasted a lot longer than some of the ones in the past because they got creative and they keep on going from gold backed to, now it's basically still oil backed and military backed. At some point things are going to fade, and what's going to last are hard assets. And so when you see something like gold start to rally like this, it's not just people like you and I, retail investors, who are buying gold. You know who also is a huge buyer of gold right now? All global central banks. Global central banks are allowed to hold their own native currency, whether that's like euro, for example, dollars. Well, they have to have dollars, and gold. Those are the three things that they have. Not Bitcoin yet. That will be the day when there's an announcement that's sent out saying that global central banks are now putting Bitcoin on their balance sheet. Man, I'm sure that will happen one day, but when that happens, man, look out. Um, so yeah, I mean, with us living in a fiat currency system, um, that is fueled by the practice of usury, which is the practice of having interest rates on when loaning out money, which is a sin in the Bible, by the way. And you can go down the entire central bank rabbit hole there if you guys would like. But when just looking at history, um, fiat currencies don't last that long, and what lasts long is hard currencies and hard assets. So I'll always own gold in my portfolio no matter what. I definitely am more weighted towards it now these days, but again, it's a waste of time to try and call tops. Okay. Let's see. What other ETFs were doing good last week? Silver was also doing good despite its little sell off there. Let's see. Japan. Computer's going nice and slow. I love it. Yeah, Japan looks like it had a pretty decent week last week, going back to a bullish trend when it had that huge drop off there a couple weeks ago. So that's definitely interesting there. Yeah, it looks like emerging markets are having a little bit of a pop just because of the dollar going down to the low of the trading range. So um, that's definitely interesting there. Dollar still remains in bullish trend though. So I would probably take this opportunity if you guys, well, I can't give financial advice, but for myself, any type of emerging market ETFs that I have exposure to that have broken trend, definitely a good spot to get rid of them. Yeah, and Japan is right at the top end of the trading range, so definitely will not be buying that there, but good to see that it's gaining strength back. Let's see. Utilities is always a good one. XLU. And then bonds were doing pretty good last week as well with that huge, with bonds really having a sell off there. So yeah, that's pretty much all I have for you guys. Yeah, we're coming up on half hour right now. So what we'll do is, we'll go ahead and transfer over to just the people on the Zoom call within our community, where we're going to talk about some more actionable ideas with certain stocks, taking a look at that, as well as some of the moves that I'm looking at coming up here this week tactically, right? So looking at the charts, but I appreciate everyone for joining. Again, if you guys want to join us after offline for the second half of the Sunday Macro Wrap Up, just go on our website there, macro-optics.com, and you can take a look at that 7-day free trial of our community there. But I hope everyone has a great rest of your Sunday evening. Good luck out there, and we will catch you on next week's Sunday Macro Wrap Up. For those on the Zoom call, hang tight while I just close out of the stream here. Bye, YouTube.